The rapid evolution of digital assets has forced regulators to confront a foundational question that could no longer be avoided. What exactly is a cryptocurrency, legally speaking? For more than a decade, the United States operated without statutory clarity, relying instead on regulation by enforcement, creating uncertainty for innovators, institutions, and investors alike. The Clarity Act represents a structural attempt to end that uncertainty by introducing objective rules, not opinions, to classify digital assets based on how they actually function, not how they are marketed. Rather than banning or approving specific tokens, the Clarity Act introduces a framework that divides cryptocurrencies into three distinct legal categories. These categories are determined by measurable properties such as control, decentralization, and economic reliance. Understanding this framework is essential because it explains why Bitcoin, Ethereum, and XRP are treated very differently under modern regulatory logic, and why those differences matter far more than price or popularity. At its core, the Clarity Act is grounded in long-standing securities law, particularly the Howey test, while acknowledging that blockchain networks introduce new realities that traditional law never anticipated. Instead of assuming all cryptocurrencies are securities, the Act asks three fundamental questions. Is there an identifiable controlling entity? Do purchasers rely on the managerial or entrepreneurial efforts of others for profit? And who governs changes to the network and its economic rules? By answering these questions, a digital asset is placed into one of three regulatory categories. This approach shifts the debate away from ideology, narratives, and marketing slogans, and toward verifiable decentralization and structural control. In other words, what matters is not what a project claims, but what its architecture proves. The first category under the Clarity Act is digital commodities. These assets are defined by the absence of any issuer, sponsor, or controlling organization whose actions materially influence the asset's value. There is no central authority, no managerial roadmap, and no dependency on ongoing human decision-making for the network to function. Bitcoin is the archetypal example of this category. Its creator is absent, no entity controls protocol development, and no investor reasonably relies on a management team to deliver profit-generating outcomes. Governance is emergent, voluntary, and resistant to coercion. Under the Clarity Act, assets like this fall under commodity-style oversight, reflecting their role as neutral digital infrastructure rather than investment contracts. The second category, and the most misunderstood, is decentralized digital assets. These networks often begin with a founding organization, but evolve to a point where control becomes sufficiently dispersed. What defines this category is not origin, but outcome. The network must function independently of any single entity, with governance requiring broad, independent consensus. Both Ethereum and the XRP ledger fall into this category under Clarity Act logic. While each had early sponsors, neither network today can be controlled by its original developers. In the case of the XRP ledger, changes require approximately 80% validator agreement, while Ripple's validator influence remains well below the 20% blocking threshold. This mathematically removes unilateral power by design, not by promise. Because investor reliance on managerial effort has been structurally eliminated, these assets do not meet the definition of securities. Decentralization is not assumed, it is demonstrated. And under the Clarity Act, architecture matters more than narrative. The third category includes digital securities, which most closely resemble traditional investment contracts. These assets typically involve a central issuer that raises capital from the public with explicit or implicit promises of profit derived from ongoing managerial efforts. Development, marketing, and governance remain firmly centralized. Common indicators include token sales used to fund operations, roadmaps designed to drive token value, and governance structures where insiders retain decisive control. Under the Clarity Act, These assets are regulated like traditional securities, including disclosure requirements and investor protections. Importantly, classification is not permanent. A digital security may transition into a decentralized digital asset if it demonstrably removes centralized control. Rather than relying on tables, the distinction is simple. Digital commodities have no issuer, no managerial reliance, and purely decentralized governance. Decentralized digital assets may have originated with sponsors, but are now governed by distributed consensus with no entity retaining decisive influence. Digital securities maintain an active issuer, investor reliance on managerial effort, and centralized control. This structure allows regulation to adapt dynamically as networks evolve, instead of freezing innovation into outdated legal definitions. Control is no longer ignored. It is measured. The Clarity Act's framework provides institutions with something they have lacked for years: legal certainty. Financial institutions, sovereign entities, and infrastructure providers can engage with digital assets knowing exactly which regulatory regime applies. Most importantly, it incentivizes projects to engineer decentralization rather than merely claim it. Under this model, control becomes a liability instead of an advantage. The less influence a single entity has, the safer the network becomes from a regulatory standpoint. This aligns innovation with compliance instead of placing them in conflict. The Clarity Act does not redefine cryptocurrency. It reveals its true nature. By dividing digital assets into commodities, decentralized networks, and securities, the Act replaces speculation with structure and ideology with evidence. Decentralization is no longer a slogan, it is a measurable property embedded in code. As this framework matures, it signals a future where innovation and regulation are no longer adversaries, but co-authors of a more transparent and accountable financial system. Bitcoin avoids control by being rigid. Ethereum tolerates influence through social consensus. The XRP ledger eliminates leverage by design. Bitcoin is decentralized because no one can change it. Ethereum is decentralized because no one controls it anymore. XRP is decentralized because no one ever gets the power to begin with. XRP did not escape security classification by arguing with regulators. It escaped by removing the very thing regulators regulate: control. What ultimately matters is not which asset you hold, but whether the system you engage with is built on assumptions or on proof. The Clarity Act formalizes a principle that has quietly governed resilient networks all along: systems that minimize trust in people and maximize reliance on transparent structure endure. As regulation continues to mature, this distinction will increasingly separate projects that merely exist from those that last. Understanding that difference is no longer optional. It is foundational to navigating the next phase of digital finance. We inform, you choose. In this library, we do not offer false hope or sensational claims. The information shared is based on observable structure, legal reality, and real-world financial development.